let's kick it off right away. We've less than a half an hour, and we want to save some time for some audience participation as well. Thank you guys very much for being here. We're going to start from we're going to take a funnel approach. Start with the big picture, macro, and then kind of work our way down to some of those individual opportunities and themes that we're going to explore. So maybe I'll start a little bit with an open-ended question, and we'll let our panelists weigh in as they see fit. And that is just how much attention and big of an opportunity is the idea of allocation to private investments, and how much are your clients actually asking for that kind of product?
Sure, I'll give that a shot. So I love the fact that you first off talked about private markets and not alternatives, because I think that's a really important differentiation. As we think about the private market opportunity, I think for several decades at this point, as we've transitioned from private markets to being solely an institutional opportunity to increasingly, whether it was for family offices or ultra high net worth clients, being able to afford those opportunities to a broader client base, I think the challenge has been, how do you bucket those alternative opportunities? And for us, as we look at the landscape at Neuberger Berman, we really see that it comes down to the structure of the assets. And so if you're thinking about equity, for instance, there's both public and private equity. If you think about credit and debt, public and private. And then you truly have some non-correlated alternatives, which we might have a chance to get into. But the way that we think about it is really, how do you incorporate those exposures along a frontier, always keeping in mind what's the desired outcome. And so your expression of these exposures, your expression of how you put alternatives within your portfolio construction really depends on what you're trying to deliver. It also depends on the market environment, and it depends on what our relative valuations, where the opportunities are, and more importantly, over the last couple of decades, where the dislocation lies, because that's really where, if public markets are dislocated in some way, private markets can come in and be that liquidity provider. So the way that we think about that is really, is there a meaningful rationale to apply a private markets allocation? And then you have to think about sizing, timeline, perspective, all of those things that go into that.
Akash, I saw you nodding over there really quickly. Just before Raj, I know that you were going to weigh in there for a second. Is there a reason why you thought that resonated with you?
Yeah, I think BNY, we distribute about $3 trillion of asset management product across our channels, and we work with over 100,000 advisors. So we have a pulse on the market, and I think a couple of things that just resonate. I think when we do every advisor poll, access to alternative products is number 1, 2, and 3 on their list of things that they want more of. So there's a demand. 2 is when you look across that 3 trillion, less than 1.5% is in alternatives today. And if you do the allocation models, it should be somewhere closer to 10 or 15%. So there's just a gap that needs to be filled, and that's a burgeoning supply and demand that's being created in the market right now.
Yes, Raj.
So what we try and do is think about the thematic for the clients and simplify what's the role for alternatives, but not in the voice of alternatives. So durable income is a theme that comes up time and time again. We've seen the high correlations of volatility in public fixed income, and there's tremendous demand for floating rate, directly originated lending vehicles. There's tremendous demand for diversified equity. There's a huge amount of interest for tax-advantaged real assets. And so those tend to be themes that frame the dialogue that we've had with clients.
Yeah, so I think also people overcomplicate it, right? All we do is credit, but the reason you own private equity private equity is to outperform public equity, and the reason you buy private equity is because there's less public companies. So the alternatives private equity exposure is just equity exposure. And the private credit exposure is because there's less public credit instruments, so you buy private credit for higher return than public markets. And so that's a credit exposure, right? And so I do also think, like the world doesn't change every day. These are other ways to get exposures to real estate, credit, equity, but it doesn't necessarily need to be super complicated. It's merely just another expression of the asset classes we've always known.
Can I follow up really quickly on that? These types of investments have been available for decades. decade. I mean, they've always been there for a certain class of client and a certain type of customer. Why do you think it has been in the last maybe 3 or 4 or 5 years where the visibility and demand for these types of instruments has now taken a ramp up, the likes of which we've seen? I mean, we talk about private investments throughout the course of the last 20 or 30 years, but all of a sudden these days it's in the news like all the time. Why? What happened? And why are advisors now dealing with so many clients who want to get these types of things?
Yeah, I mean, banks used to be the leverage that allowed private equity to buy companies. And after 2008, the Fed doesn't want banks doing that with capital that is levered 12 to 15 times. They want it on end investors. Our capital, we have about 150 billion under management. Half of it has no leverage, and half of it is levered 1-to-1. And so the Fed is accomplishing what they want, which is get the risk off the banks, we believe. And really it's grown since 2010, private credit has gone from a couple $100 billion to $1.5 trillion today. So the asset class really has, moved hands from banks where people felt, that wasn't the right hands for it, perhaps, to sort of end investors. And private equity has also grown at the exact same pace. And so private equity has also tripled in the last 15 years as an asset class, given the lack of public options.
Yeah, I mean, I think it's about supply and demand too, but as well as technology and transparency. So if you go back 15 or 20 years, the amount of deal flow that a manager might see would be really limited in scope to their personal network. And I think that now there's not only both portfolio companies in particular who require debt and equity solutions, but they know that there are these firms that can partner with them and create very flexible solutions. So a question we get a lot about private credit in general is that if we're facing down Basel III Endgame regulations being severely diluted from what was expected, and so will the securitization market come back? It actually probably doesn't matter all that much because now portfolio companies know that they can get a much more bespoke and creative solution from private credit providers. I also think that if you look at the return profile of sort of the pre-pandemic period, fixed income is yielding very low yields, and so private credit was attractive in that way. Fast forward, though, to when yields were spiking, and that delta really created an equity-like return for private credit. So again, it goes back to not only the manager or the firm or the fund opportunity, but what's the market opportunity and what's that relative valuation? Equities seem expensive, but yet you can get this much from a credit opportunity that gives you equity-like returns. I think that's why you've seen so much enthusiasm around private credit over the last couple of years.
I also think the growth in the private markets is largely due to how narrow the public markets have become. And so the way we think about it today is the private markets offer what the public markets might have 20 years ago. Here you have massive diversification opportunities through secondaries. You have massive wealth creation through asset classes like real estate that are much more democratized. So unless you want to trade the Mag 7 every day, then the private markets has actually become, or if you want to participate in an IPO, which is difficult today, the private markets have replaced that sort of cocktail party effect, provide a lot more diversification, a lot more sort of risk-adjusted return opportunities. And there's so much wealth today that the largest families have earned through highly illiquid asset classes like real estate, and I think that becomes a big part of the narrative too.
How much is liquidity a concern or a benefit or a drawback to the kind of investor demand construct that you're seeing? So you mentioned the Mag 7. People trade it all the time because, let's be honest, I could drop 5 million shares at market on NVIDIA and it would move the stock maybe a penny a share by the time it's done. There's a reason why, because they saw those hyper returns in public markets in immensely liquidly traded investments that don't have the same kinds of risks to getting in and out or the kinds of gates or redemption kind of restrictions that you had. How do you get over that aspect, Raj, of Mag 7 versus the types of things that you're talking about?
Individuals in general hold way too much liquidity. And they'll hold, as Akshay said, 90% of the public markets. In any downturn, top leading advisors spend an enormous amount of time keeping them invested. It's the time in the market, not timing the market. So if you have 95% of the public markets, that's your liquid basket. And I think everyone should accept that the risk-adjusted above-market return, the 400 or 500 basis points you get in the private markets is in exchange for an illiquid asset class. But that's a small part of your overall portfolio.
So from an allocations perspective, Akash, if they're going to do that, how exactly should an investment advisor view what type of allocation I mean, it's KYC, I get it, and everybody's going to be different, but what kind of jumping off point does an investment advisor who doesn't have a lot of exposure to private instruments need to contemplate in order to kind of get their foot on, in the door to start moving and migrating assets on an allocation basis?
Yeah, I think, Dom, the question for all of us should be, in some ways, while private markets may not fit in everyone's portfolio, ultimately it behooves all of us to make it as simple to invest in those products as anything else. That's the way the market has to evolve for this to be a permanent part of the sort of life cycle of capital markets, and we're not anywhere close to that. Over the last 4 or 5 years, though, there have been some huge steps made by both the fund managers and all the piping that connects those to the advisors, and then the advisors themselves, right? It's more clear and sort of transparent set of products, better education and tools, better portfolio management and risk analytics to really understand these different risks that you encumber when you're doing in private markets, like liquidity. But we're still on that early stage of that. But once we cross certain thresholds, and I think we're pretty close, this will become a much more standard part of a high net worth individual's allocation. It's a very natural form of diversification. We haven't built the infrastructure yet to do it at the ease that the advisor and the end investor requires.
I think the idea around this, and I couldn't agree more, is this idea of this incremental move, right? So if you look at a large institution like a pension plan, they could have upwards of 35 or 40% of their portfolio in truly illiquid assets. And I think the challenge here, and I worked on a paper with Kaya that talked about getting off of zero. If you go to your client as an advisor and you say, I'd like you to get to a 20% alternatives, semi-liquid, illiquid allocation in the first year, and they're starting at zero, that's going to be really difficult. And so what I think some of the structural changes and the innovation in the industry have done is that they've provided you with some options where there might be some limited liquidity. There might be a diversified fund, if you will, that you can start with that first foray or that first leg into that allocation. And then over time, you can add those specialized exposures around the margin. But I think it's really important to understand that if you're going and that's your first conversation with a client about going into something that's illiquid, liquidity is always something that people are going to demand. If I don't gain enough from being illiquid, I won't justify the lack of being able to make that decision on any given day.
John, the first leg is something that I want to talk about right now that Shannon just brought up. There is an initial conversation, first step to getting exposure to some of these types of instruments. In your mind, what is that kind of, I hate to use the term, what's the gateway drug? What is the thing that kind of gets people to be comfortable with an allocation to a different liquidity profile, but one that serves a very important diversification tool in their portfolio? And what would you put a person who has no exposure into right away to dip their toes in the water?
Yeah, I think education for the advisors and for the clients is key. What's really changed, but to your question earlier, is the technology that advisors can use to access this. Of our 150 billion, half of it is insurance companies, roughly. Signing long documents, SMAs. Now you can come into a vehicle on a monthly basis and get quarterly liquidity after a 1-year lock. Right, and so you start simple, you start small. Obviously, as everyone said, what is your illiquidity budget? Right, some of these things you can get out in a year, some things you can get out quarterly, some things take 5 years to get out of, sort of. But in my experience, a small step. Some of these products offer income, like some of the credit products offer a monthly dividend. So sign up for this thing, and you're not buying green bananas. You don't have to wait to see the fruits of it. After the first month, you get an income check. And sort of, that's really what's evolved, is instead of waiting to be drawn down and get money out over several years in the traditional funds, you can start seeing it and quote unquote, eating it, instantly.
So the private credit is the reason, and that's the reason why it's become kind of like the tip of the spear when it comes to investors focusing on the private market aspect of investing?
I think the REITs did a very good job, 7 years ago. I think, private equity's been around a long time. I think the vehicles, which are the, fully invested evergreen vehicles in all these asset classes the last 3 years, and the technology is really the confluence. And people are able to get the exposure that institutional investors have gotten for, as you said, a very, very long time. But without it, it is sort of the perfect storm of opportunity set, technology, and structure of product.
Raj, your firm is very well known for the types of offerings that we are speaking about right now. I remember I was literally golfing on Sunday with a private banker, unnamed. We were sitting there, and we're looking at Century City, to that brand new Aries sign that's gone up right in the middle of, Century City. And it tipped off a conversation about how, how much I'm allocating to private investments now. And this is ultra high net worth that he's dealing with. What exactly, because I didn't get into what he's investing in or what he's allocating to, what exactly is the value proposition, and what types of investments do you see the most demand for from the Aries perspective?
Well, so I won't go into the golf, but I do think I might step back and take a different narrative on a point you made earlier. 20 years ago, alternatives really were largely private equity or hedge fund opportunities. Today at Ares, as an example, we have 6 semi-liquid strategies, all well over $1 billion across all the private markets. So PE-focused secondaries fund, non-traded REITs, private credit, BDCs, and interval funds. So all of that allows us, as I said earlier, to be very client-oriented. If the client's worried about inflation, if they're worried about rising rates, if they're worried about growth strategies, you can create a basket of alternatives across the asset classes, and we can be product agnostic. And that's sort of at the heart of our value proposition for the advisor. We don't have a view that this is an opportunity to pick one strategy, because today maybe private credit is in demand, maybe secondaries is the flavor of the month. But we just think you need to have access to democratized funds. You can allocate to them at any moment in time. And so that's been a big part of our build out, to be able to be agnostic to any one asset class and just focus on what the client's goals are.
Was the guy able to get you out of your retirement portfolio of all the MAGA stocks, or no?
For me, I would say this, because I am not a person who I would typically think of as somebody who would be in private instruments, right? Private type investments. I think that there are folks like me out there who understand kind of what they are and kind of what they do, but always felt as though that's kind of out of the realm. Like, it's not something that I need because I don't fit that HNW, UHNW profile that these people would invest in these types of real estate investments, or these types of, private credit investments, or these types of private equity investments. But if that paradigm is changing, then how exactly do folks get in on that and feel like that they belong? How about that? How is the inclusiveness factor into that particular equation when this has been this kind of thing that not many people have really dealt with in their lives, but maybe should?
Well, can I just go back to a comment on the transition of our businesses in firms that have very large private markets opportunities and teams. it's really been about innovation and evolution. And so if you think about it, a lot of these products, and it kind of goes back to your question, Dom, it's really not born out of, oh, we need to find a product that meets this demographic of our client, or we're actually we're creating solutions and solving problems for the companies that we're serving, for the people that need liquidity, and how do we do that? And so a lot of the strategies and the products have been born out of, hey, this is a great opportunity for us to, in another way, expand the capabilities that we have on tap. And oh, by the way, could they work for clients that are outside of those large institutions that have a perpetual mandate, that have vintage year investing that goes out 10, 20, 30 years from a programmatic perspective? Could this be something that we could open and widen the aperture for different types of clients? So I think it's important to differentiate the fact that, products are not created for sales alone. They're really created to provide a solution for our partners who require liquidity, and there's been so many different ways, due to the changes in the financial system in particular, that those solutions have been able to be monetized by firms such as ours.
Yeah.
And base rates have changed. Like, the world has changed a little bit, and when you're looking out there, you're looking at equities, you're looking at credit, you're looking at the opportunities ahead. I think you got to use a different lens than just long equities, which has worked for 15 years. And I think there's a lot of different vehicles to do it.
Yeah, and I would say a good test always is, what are people outside the U.S. trying to do here in this market, right? If you're a non-U.S. asset manager and you want to access the holy grail, which is the U.S. wealth community, what are you going to try to bring out here? And we serve a lot of them. And these days, it's infrastructure, right? That's the next big societal and macro problem to solve.
Is that like direct investing in infrastructure?
That's right.
Those types of products? And how exactly does that kind of work, given the demand profile that you're seeing from those types of investors?
I think it goes back to this whole idea that we're just at very different duration periods for different types of investors, right? And there's this intergenerational wealth transfer that's about to happen. People are going to take a longer view. And from a pricing standpoint, particularly in Europe and out of there, you can find yield that is a little bit harder sometimes to find in the U.S. So I guess when we think about, to Shannon's point, like this whole idea that we're never going to stop trying to solve these big market problems using these different types of asset classes. But I think the difference now is we're now thinking about this retail and wealth channel as a major and significant part of the investor base. I think it was never really thought through from that back out. And now we can think about that in how we structure the products, how we size them, what kind of liquidity profiles and models can we offer, and very importantly, how it connects all through this ecosystem to make it easier for someone to actually buy it.
But one thing that is so different about the wealth channel than institutional clients is not only is the return after fee important, but tax is a crucial part of the dialogue, whether you're the high net worth or the ultra high net worth, or whether you're
or just lowly me,
Dom,
just lowly me with a
sounds
401k and whatever else.
You will be extremely focused on your return after fee and after tax. And I think in infrastructure and real estate, we see that time and time again.
Okay. We've got a handful of minutes left. And what I would like to do with the remaining time that we have here, I'm always asked by my bosses at CNBC, and Shannon kind of knows this because she sees what we have to do on a daily basis, but there's always a desire to hear something not necessarily totally hard actionable, but something that we can take away with regard to what the next step is. So I'd like to end this program and allow each of you some time to talk about the topic, which is the opportunities in private credit, and where you think the opportunities lie in the future, maybe 6 to 12 months, maybe 2 to 5 years. We talked about infrastructure, but maybe with the time allotted we have left, we'll let you guys each go down the line and talk about where you think the opportunity is.
Yeah, it's not that exciting. I think steady NAV and income is what the best opportunity for private credit is, what your liquid loan mutual fund used to be. By the average hold of a mutual fund, someone told me, it was like 5 years. Like, you were holding your mutual funds for a long time anyway. We're trying to offer you steady NAV and higher income. And that's all that is. And so I do think some of the first steps should be the easiest steps. And then there's a whole bunch of other places that have amazing. I'm gonna take the easy one and then kick it to you to come up with something more dynamic.
So there's been a lot of talk about secondaries, and we've talked about being a liquidity provider in this environment. And so we've seen a lot of private equity secondaries to provide needed liquidity, particularly for LPs that have that vintage year programmatic approach. I'd say real estate secondaries are a place that we're very excited about right now. And so if you haven't looked at real estate secondaries, real estate is a lot more, as Raj knows, than office. And so, so that's a place that we think is pretty interesting.
You know, the place I would actually take it is to the deployment of all these funds that firms like ours are able to raise the capital. Deploying capital in private credit today is actually the edge that creates the above market return. And Ares has been doing it for almost 30 years. We think that history through different market cycles really bears out. And the secondaries team has a 20-year plus track record. Same with real estate. Everyone on the panel today has that type of a firm. But we are seeing firms show up now raising capital, and they really don't have the capacity to deploy it. And that's something you need to think about today more than ever.
So, cheating a little bit, I will go back and double down on infrastructure, but I will say one thing. I think all of us, we're going to see through multiple cycles of these different asset classes, perhaps even private credit. I think the most important thing is we have to think of this as not a fleeting moment in a market. This is here to stay. And this will become a permanent fixture of people's portfolios. And that's the sort of mindset that, in terms of opportunity creation over the next 6, 12, and much beyond that, I think the one we have to take as an industry.
All right. That does it for us here now. I've gone just slightly over our allotted time, but I want to thank our panelists right now for a conversation, by the way, that I wish could have lasted another half an hour at this point. Thank you guys very much for the conversation, and thank you for attending the audience as well.